This is Optimal Finance Daily, episode 1817, Mortgage Paydown Strategy in a Rising Interest Rate Environment by Sam of FinancialSamurai.com. And I'm your host and personal finance enthusiast, Diana Merriam. And now let's get right to today's post and start optimizing your life. Mortgage Paydown Strategy in a Rising Interest Rate Environment by Sam of FinancialSamurai.com. In a rising interest rate environment, you need a mortgage paydown strategy. Mortgage rates are at all-time lows now, but it's always good to think about the future. Here's a case study on how to think about paying down your mortgage when mortgage rates were rising back in 2016. With so much stimulus unleashed due to the pandemic, there's a chance that inflation returns by 2022. If so, interest rates will likely go up again. Mortgage paydown strategy. Being mortgage-free is generally a good thing, but there are times when you want to accelerate your mortgage paydown, and there are other times when you want to leave it well alone. With the aggressive spike in interest rates post-election, it's now time to assess whether paying down your mortgage quicker is a good idea. Borrowers who took on debt and locked in a lower rate before the election are winning. Banks who lent people money before the election are losing because they could be earning a higher return today. In other words, the value of the mortgage has risen for borrowers and declined for lenders. When something rises in value, you do your best to hold on for as long as possible. Therefore, paying down your mortgage faster when your interest rate is fixed is a suboptimal move. Example of not paying down your mortgage. Here's an example of a $500,000 mortgage that demonstrates this point. 5-year adjustable rate mortgage interest rate lock before election, 2.5%. Equals $1,975 a month. 5-year adjustable rate mortgage interest rate after election, 3.25% or $2,176 per month. Instead of prepaying down a fixed 2.5% rate, when the best a borrower can now get post-election is 3.25% for the same loan, save the difference. The most conservative strategy is to save the $201 monthly difference for 60 months and then pay down $12,060 in principal the last month the 5-year adjustable rate mortgage adjusts if you plan to refinance or let the mortgage adjust. If you plan to sell the property by then, you'll just keep the change. A more aggressive strategy is to invest the $201 monthly difference in some now higher yielding bonds, given they have sold off due to the interest rate increase. An even more aggressive move is to invest the $201 monthly difference in a mix of stocks and bonds. Finally, the most aggressive strategy for a lot of people is to invest 100% of the difference in stocks and hope the raging bull market continues. Your decision will depend on your risk tolerance and financial goals. For those of you wondering about 30-year fixed rates, they've risen from around 3.625% to 4.125% post-election. What am I doing? Because I operate under the overarching belief that less debt is better than more debt, I will continue to pay down some extra principal on my 4.25% 30-year fixed Lake Tahoe property mortgage that cannot be refinanced. However, my original plan of paying an extra $50,000 a year in principal over the next 6 years to pay the sucker off by 2020 is now no longer happening. Instead, I plan to reduce extra principal payments by 50% to $25,000 a year. The $25,000 in freed up capital will now be used to primarily focus on building a municipal bond portfolio in order to live for free in my primary residence. I've also built a sizable $810,000 real estate crowdfunding portfolio. It earns me income 100% passively at about a 10% internal rate of return. I believe owning real estate in 2021 and beyond is a wise decision. Funny money from stock gains will flow into real estate. Mortgage rates will stay low. Further, the value of real estate has gone way up since we're all spending more time at home. My tailored mortgage paydown plan. I have a 5/1 adjustable rate mortgage at 2.5% that is adjusting in July of 2019. Although the interest rate is low, with only 25 months left of the fixed rate, I've got to come up with a plan to pay down extra principal payments so that if it were to adjust to 3.25%, I'll still be paying the same amount of interest. Surprisingly, all I've got to do is pay down $19,000 of principal by July 2019 to maintain my same payment at 3.25% because I've already paid down $70,000. Plan done. Finally, for my property with the newly refinanced 2.35% rate, I will no longer be paying down extra principal until the last month of the 5-year fixed term ending August 2021. When the time comes, I will reassess the interest rate and real estate landscape to decide whether to pay down a lump sum, refinance, or let the mortgage float. Stay fluid, my friends. The rise in interest rates post-election proved temporary as investors realized many of Trump's economic policies aren't going through as quickly or as cleanly as first proposed. For those who missed the refinance window, you best try again now that interest rates have come back down in 2021. Pay attention to what's happening in the world and adjust your allocation of capital accordingly. I'll help keep you abreast through topical posts and my monthly newsletter. Don't be fixed in your way of thinking. So long as you have capital coming in, you have the luxury of figuring out how to best optimize your finances. It's comforting to know that sooner or later our mortgages will be paid off and we'll be able to drastically lower our cost of living or generate an increase in rental cash flow. We just have to decide how soon we want to experience that day. You just listened to the post titled Mortgage Paydown Strategy in a Rising Interest Rate Environment by Sam of FinancialSamurai.com. I think it's important to point out here that it looks like Sam has a strategy of taking on adjustable rate mortgages for some of his investment properties, but he does mention having one 30-year fixed loan. While he doesn't expand upon why he has some adjustable rate mortgages, I encourage you to listen to episode 1761, where I read an article from Paula Pant about why she thinks adjustable rate mortgages are a big no-no. Even if you plan to sell before the rate goes up, or you have confidence that you'll be able to refinance, or you follow a strategy that Sam describes here with paying the principal down enough during the lower rate period that when it switches to the higher rate, it's applied to a lower loan balance, so you make out better in the long run. The risk might not be worth the payoff. You're banking on a lot of things going right at the right time and are leaving little wiggle room for life to happen, which it always does. I'm a fan of a 30-year fixed mortgage. The only thing you really need to think about with rising and falling interest rates is if they fall enough where it makes sense for you to refinance. Also, when it comes to deciding to pay off your mortgage for your primary residence, my general rule of thumb is that I don't want more than 10% of my net worth in my home so that I can put the bulk of my money in income-producing assets. Many people have strong feelings about whether or not they should pay off their mortgage. So I think looking at this question in the context of your overall financial picture is particularly helpful. That should do it for another edition of Optimal Finance Daily. I'll be back tomorrow as usual. So I'll see you there on the Wednesday show where your optimal life awaits.